Will mortgage stress be the beginning of the end of the great Covid-19 property boom? Well, that's what the media would have you believe when they're saying that the average household in a raft of suburbs around Australia could be pushed into mortgage stress if interest rates rise only 1%. So in this week's Property Insider video, Dr. Andrew Wilson and I will explain what we think is happening to mortgage stress around Australia. We'll also talk about unemployment. The latest figures have obviously shown rising unemployment and what's happening in our property markets. If you want to keep up to date with Australia's real estate and housing markets, why not subscribe to our YouTube channel and click the little bell icon so we keep you up to date every time a new show comes out. The average Australian household in a raft of suburbs is going to be pushed into mortgage stress if interest rates rise just 1%. Well, that was the headline doing the rounds over the weekend. And only a few weeks ago, modelling by one of Australia's most highly publicised property pessimists, who unfortunately keeps getting his predictions very wrong, yet keeps getting the headlines in the financial press. Anyway, his modelling suggested that a minimum mortgage rate hike, combined with the higher buffers now required by APRA, the edict to the banks, that would send thousands of residential landlords into financial stress and could fuel house price falls by the end of next year. So will higher inflation rates lead to higher interest rates that are going to eventually tip the scales and spell the end of this current property boom? That's one of the questions I'm going to be asking Dr. Andrew Wilson, Australia's leading housing market economist and chief economist of My Housing Market, in this week's Property Insider chat. And I'd also like to get his insights into what's happening with the higher unemployment, considering our unemployment rate shot up last month. Hi, Andrew.
Hello, Michael. And mortgage stress, is that the headline that just keeps on giving? I think it is, but we have to address the clickbait, regardless of its ludicrous nature or not. But hello, I've given it away a bit, my opinion.
You've already given a spoiler alert. But Andrew, it is the story that won't go away. And even though we've discussed it over the last couple of weeks, we really must address the speculation now at the next level that higher interest rates could lead to mortgage stress, not only for homeowners, but for property investors. And even more importantly, we need to address the concern that some people may have after watching the 6 o'clock news or reading the papers and being told the value of their homes could plummet 15 to 20%. Now, we know that falling interest rates increases borrowing capacity and it fuels housing price growth. And while the opposite, rising interest rates, does decrease borrowers' capacity, Andrew, in my mind, that doesn't necessarily mean that the value of houses around Australia are going to slump.
Well, they'd only slump if they were sold, Michael, wouldn't they? I mean, that's the point. Nothing has value until there's a buyer and seller engaged. Yeah, look, it seems like year after year we are confronted by the mortgage stress headline, the debt bomb. Whatever happened to the debt bomb? That was supposed to blow up a couple of years ago. And of course, right. It's all predefined by a rise in interest rates. We say, okay, well, if interest rates rise by X, this will happen. So let's forget about the supposition that it's all about higher interest rates and then get on with what the outcome would be, even though the actual supposition is completely fanciful at a number of levels. It's like saying, gee whiz, we'd be in big trouble if we were invaded by Mars, wouldn't we? But without thinking about, well, what's the likelihood of being invaded by Mars? I am being facetious, but you can see my point. You have to look at rationalising the actual risk of the problem that you are suggesting will cause these negative issues. So let's just quickly, again, deal with interest rates. Firstly, the supposition in terms of the report that this widespread mortgage stress is based on a 1% increase in interest rates. So will we see a 1% increase in interest rates? Well, firstly, as we know, and we've said over and over again, the last increase in interest rates, Michael, was Melbourne Cup Day 2010. So basically 2 decades ago, 11 years since we've had an interest rate increase. Well, looking back doesn't necessarily tell us what's going to happen going forward. But given the fact that incomes growth is low, that inflation is still low, regardless of the recent spike, we're probably further away now than we've ever been from an increase in interest rates, official rates, particularly given we are certainly still in a recovery phase in our economy. That would mean, however, let's look at the issues beyond the macro economy, that the Reserve Bank would increase interest rates by 1%. So I guess using at the very most a 0.25% rate increase, that's favoured by the Reserve Bank until recently, that would mean 4 interest rate increases. And of course, the supposition is we'd go bang, bang, bang month after month, or just a 1% increase. Now let's consider the last time, which is highly unlikely. It's fanciful, it's ludicrous, yes, but let's move on to other factors. Now, the last time we did have a 1% increase in interest rates, Michael, over a shortish period of time was in 2006-7 and again in 2009-10. Now, the reason interest rates increased because we were experiencing the mother of all mining booms in those periods, and we had incomes and inflation absolutely going through the roof. Incomes growth in both those periods was pushing 4% per annum. We're going to see again a very low income growth result for the September quarter this week, released by the ABS. We will be very fortunate if annual incomes growth matches that of the recent annual inflation rate. Now, that would mean real incomes are actually falling. So these are completely different circumstances currently than what we had when we had the last short-term increase in interest rates. So it's just completely ludicrous to assume that. So if we did have that 1%, Michael, guess what? We would likely, given previous historical circumstances, have incomes going through the roof. Guess what that means, Michael? It means you've got more money in your pocket to pay off those higher interest rates. That's the whole point of why the Reserve Bank would raise interest rates, because we would have had strong incomes growth. So why would we have mortgage stress given higher interest rates if those higher interest rates were being generated by very strong incomes growth? The other speculation is the banks might raise rates out of cycle. Well, that's complete nonsense as well. Why would the banks act to take away demand out of their basic business model? Because that's what would certainly happen if they unilaterally raised interest rates outside what the Reserve Bank was doing. And of course, it would create a firestorm of public outrage that they would be doing that, which would again question the role of banks and their market power. Now, the other point, Michael, is why would we get all these households experiencing stress with higher rates? The vast majority of those that own their own homes or are owning their own homes in Australia, Michael, actually own their houses outright. They don't have a mortgage, so what do they care? And the other point is that the vast majority of those that have a mortgage actually have high equity and low levels of borrowing. With the easing of the housing cycle, which is becoming apparent now, we will see fewer buyers in the market. Prices growth will start to moderate from the extraordinary high levels of the past year. And that means that people will be less exposed to issues of higher interest rates if that occurs. The other point is the banks provides a buffer for new borrowers that they must cover now 3% above their rate of the mortgage that they do secure. They must show that they can repay an extra 3% on that interest rate that they've got on their loan. So there's already that risk factor built into new borrowers that covers them going forward. It's a story that keeps on giving, but you're completely right, Michael, when you say that, or you allude to the fact that people buy into this nonsense, and it is nonsense, read my lips, and maybe make financial decisions based on it. We've had a wave of consumers locking in fixed mortgages and refinancing over the past this year so far, particularly the middle of the year, based on the scare campaign of higher interest rates coming along. Now, the banks have now raised those fixed term rates and are now cutting variable rates. So how would you feel if you're locked in a fixed term rate on the understanding or the belief that you were reading in the so-called quality press, and stop me from laughing, that interest rates were imminently going to rise? And now you turn around and see that, well, the variable rates are actually falling.
Well, what is mortgage stress? There's lots of definitions, but the most commonly defined one is when a household's spending 30% of its pre-tax income on their home loan repayments. And of course, the underlying premise of Andrew is that the average home buyer is suddenly going to struggle to repay their loans based on that. But as you've suggested, that's not the case. And the banks Currently, you're looking at that 3% buffer, but prior to that, a 2.5% buffer. So most people are also in a good position at the moment. And if you look at what's happening, the mortgage defaults, the mortgage arrears,
Yes.
and the banks, that suggest very few Australian households are currently suffering mortgage stress, Andrew.
Well, there are other factors, of course, Michael, and you're absolutely right, which we point to, that historically we see low levels of arrears and mortgage defaults, and they are bumbling along the bottom in terms of historical lows. And we know Australians will do anything to maintain the family home or their investment property. And we've experienced that in economic downturns where we don't see really significant rises in mortgage stress as measured by defaults and arrears, which really is the only measure for mortgage stress. And the other macro issue to be acknowledged is Australians are now saving at record levels. We have record levels of savings. Australians are prudent financial managers, and they're proving that now through the issues, the stress, the uncertainty of the COVID lockdowns, is that they're saving at the highest rate ever. So that gives them another buffer. Are we wasting our time discussing this, Michael?
I think it is important to explain this to people to counter these silly arguments, because house price collapses only occur when people are forced to sell their homes, Andrew, like you were suggesting, and there's no one there to buy them. Instead, we're not suggesting house prices won't fall. They will. That happens every cycle, and some properties will fall more in value than others, but it's usually an orderly correction that occurs. And for a crash, for a collapse to occur, as I said, you'd actually have to have a market where no one wants to buy, such as where unemployment's going to be so high that it'll trigger a wave of forced sales. That's not going to happen. Or that interest rates rise so much, not the little bits like you mentioned, but so much that there's going to be a raft of homeowners who default on the mortgage. The Reserve Bank wants this about as much as it wants a different strain of coronavirus. Or that there's going to be a credit squeeze. And we know APRA are making it more difficult to borrow, but they don't want the housing market to crash. Or maybe a severe recession would create such unemployment that people couldn't keep their homes. That's not on the cards. And the other one, I guess, is a severe oversupply. That's not happening either. So, Andrew, there's none of the underlying things that could cause a housing market to crash.
Well, really, the precondition is clearly higher interest rates, Michael. We could talk forever and ever about the outlook for interest rates is certainly still tracking at near zero. We've got so far to go to change things to get those types of interest rate increases that would cause even some downward pressure on house prices. And on the demand side, Michael, in terms of the market is now easing because we've caught up with all that we missed out on for the last few years because of all the interruptions. Demand is being satisfied. The markets are still strong across the board, but certainly not super strong as they have been. And we've still got our borders to open up, Michael. We've got hundreds of thousands of migrants in prospect to come into our country, and they have to live somewhere, Michael. Let's get it, and we haven't been building anything. The preconditions are certainly for higher prices on the demand side rather than lower prices because of the supply of finance through higher interest rate.
Well, there's also been lots of commentary about the unemployment figures. Yes. And last week, Josh Frydenberg, our Treasurer, admitted that the latest job figures confirmed that lockdowns cost jobs. Employment fell by 46,300 in October.
Yes, Michael, we're on the upward track in terms of improving, but we do have a long way to go, Michael. I think it's quite interesting that the commentary during COVID last year was skewed consistently to the negative. And I think we've sort of gone the other way now, where we're being skewed to perhaps being a little over-optimistic in terms of the outlook for the Australian economy. Don't get me wrong, I think the outlook is positive. But we've certainly got some way to go. And the figures were disappointing, reflecting on what the herd were high-fiving that we were going to have some incredible October result in the labour market. Well, we didn't. It was better, but it's still got a long way to go. We're still down over 300,000 people in the labour market, Michael, compared to where we were before we entered the mid-year lockdown. We're also around 300,000 below the actual participation in the workforce. If those people who have left the workforce over the past 3 or 4 months were actually counted as unemployed officially, which perhaps they are, we'd have an unemployment rate of 7.5%. So the real challenge ahead now, Michael, is that we need to create jobs at the same rate as people will re-enter the workforce, and they will re-enter the workforce. But we have to have a job waiting for them, Michael. And all this speculation based on job vacancy numbers and business hiring sentiment surveys, well, they counted for nothing when we look at those October results. And even obviously the big improver was New South Wales. Employment only increased by 20-odd thousand over the month, Michael, and it's still nearly 250,000 light of where it was back in May. So we need a lot more jobs coming into New South Wales. It is in recovery mode, obviously, but we need to have that to balance the unemployment rate, which is now in the 5s, predicted to be in the 4s by the Reserve Bank. So we're going to have to create a hell of a lot of jobs over the next 2 months, Michael, to offset the what will be a rise in the participation rate as people come back with the end of lockdowns. And if we look a little closer at the state data, Michael, for October, no surprise, obviously, that Victoria led the way down, lower participation rate, obviously, and falling employment. And that's understandable because they were still in the depths of lockdown. But I thought it was interesting that some of the other states that we can't use the lockdown excuse for, particularly Queensland, didn't have a very good month at all, with the unemployment rate rising, the participation rate falling, and employment levels also falling. So we know there's a lot of migration heading into Queensland, and that can be one of the offsets creating high demand for jobs, which may be impacting the unemployment rate in that state. But still, there's no COVID excuse for Queensland, and it didn't have a very good month at all. And the participation rate, even though the unemployment rate fell in Western Australia, and it's nationally low, and it's a very low number, under 4%, it did reflect a fall in the participation rate in Western Australia, which did act to help that unemployment rate fall. So look, I'm not being a negative Nelly here, Michael, but I think we still have some work to do to get to those consistent mid-4s unemployment rates that we had prior to this year's lockdowns. And the other thing I thought was interesting, that the ABS commentary seemed to be still pretty gung-ho, and they're getting a little bit editorialising, I think, on their commentary. But they did mention that, oh yes, our data only goes until, I think it was the 9th of October that they count their data to. And of course, we were just out of sort of lockdown there in New South Wales and coming out of lockdown in Victoria. So is it really an October unemployment rate, Michael, or is it more a September unemployment rate? You know?
Well, the other thing I found interesting is the underemployment rate has lifted to a 12-month high, Andrew. So there is a lot of capacity in the system still, and that means that wages growth is a little way off still.
Yeah, we'll find that out this week, Michael, when we get the September quarter wage index data released. If we get another disappointing or certainly underperforming wage outcome, which is likely over the September quarter, then it means perhaps we'll be in the position where real wages have fallen. And let me tell you, folks, that's the absolute last thing that they would be thinking about, higher interest rates, because that would really put the kibosh onto it. And this is the problem in America at the moment, Michael, that inflation is rising strongly. Again, there are a lot of one-off factors driving that, or COVID-related factors, but they have incomes rising, also are starting to increase, but still not rising at the same level as inflation. So even though they're at a higher level for wages and inflation than Australia is, they're looking at the same problems, which is the consumer's going to find it hard to make ends meet.
Well, turning to the auction markets this weekend, auction clearance rates held steady despite lots more properties on the market. Now, Andrew, around this time, the auction clearance rates typically ease, concluding the spring selling season, usually driven by higher listings, but buyers are still out there. But speaking to agents, Andrew, I'm finding that they're reporting there are fewer buyers for each property, fewer bidders registered for each auction, but the market's still moving on nicely, isn't it?
Yes, end of the year market, typically, Michael, as you said, more stock, lower clearance rates, an easing in clearance rates. It's the seasonal pattern, but we are seeing the easing of the surge that we got post-lockdown. A lot of the pent-up demand is being released now, particularly in the Sydney market, but it's now starting to become more of an orderly market because it's real-time demand and supply. I think the Melbourne market's still got some upside to it, Michael, because it has been restrained more than any of the other markets from lockdowns. Still some good value there. So high numbers of properties, 1,200 auctions in Melbourne on the weekend, and another 1,000 odd auctions in Sydney. These are big numbers for November for Sydney. But still, clearance rates are closer to 80% than 70%, which means it's still very much a seller's market. Some of the other smaller capitals also eased in terms of their clearance rates. We had some very big numbers in Adelaide auction numbers, very high on the weekend. We've only got 4 weekends left, Michael, and then that's it. So there's a lot of pressure on buyers and sellers to get the deal done before the end of the year, particularly sellers.
Well, I look forward to having a chat with you again next week when we talk about the wages figures, because that's going to make a big difference to the commentary about inflation and about interest rates.
Thank you.